As we saw just moments ago, oil inventories rose more than expected, more by 5 million barrels. For just what this means for oil prices, we're joined by Ann Kohler, analyst at Caris Co, named one of the best stock pickers for the oil industry in the most recent Wall Street Journal Best on the Street survey. Thanks so much for joining us, Ann. We're seeing such a sharp pullback. We're down about 4% in the price of crude. A build of 5 million when a drop of 1.5 was expected. Why are the numbers so off here?
Well, the DOE gets their data, that's sort of their deal. But I would say that in some regards, it's really not surprising. I mean, you saw another leg down in refinery utilization. We have, despite the draw on gasoline inventories today, gasoline inventories and distillate inventories are at, above normal levels for this time of year. Mm-hmm. And so with basically continuing to see very weak demand, refiners are cutting runs. So if you're cutting your refinery utilization, you need less barrels. And I would anticipate that as we move through the season, absent a Gulf Coast hurricane, you're going to continue to see refinery utilization leg down and builds in crude inventories.
Mm-hmm. Well, we're in the summer months. We're looking down hurricane season coming at us. What are the expectations there? I mean, what's your forecast in terms of whether that will be priced in to oil right now? I mean, are we going to see significant storms this season?
So far, we've seen actually very minimal storm activity for this time of year. Typically, we see a few tropical waves developed into tropical storms, but we really haven't even seen that this year. So certainly, less activity than we've seen. But really, the heart of hurricane season is in August and September. So there's still some time out there. But it is sort of interesting that we haven't seen, as I said, the amount of pre-hurricane season activity that we normally get. And certainly, here on the East Coast, if a storm were to come this way, we've had very cool weather. Mm-hmm. So, one of the great factors in kind of juicing a hurricane is warm ocean temperatures. So, that's another key factor to look at.
Well, we're seeing crude oil itself move down in trading right now. When you look at the equity side of things, the commodity stocks have also been under pressure throughout the evening into this morning. Mm-hmm. From the companies you cover, were you also anticipating this much of a pullback that we've seen so far in the commodity sector this week?
Certainly. I mean, we've had a tremendous run in the price of crude oil really since March, and it's really moved up with the commodity or with the equity markets. Mm-hmm. From a fundamental standpoint of view, inventories and fundamentals are probably the weakest for oil that they've been in 25 years. Inventories on an OECD basis are extremely high, about 7-8 days higher than we normally like to see for this time of year. And OPEC, in spite of lower demand, mm-hmm. OPEC has actually been increasing production, which is only exacerbating the situation. So we basically have been recommending to investors that we expected a drop in the price of crude, and so maybe lightening up your load in some of the more traditional E&P names. And then certainly on the refining side, margins there have been under tremendous pressure, mm-hmm. Particularly crude price differentials have narrowed considerably, which is a lot of the refiners try to run less expensive, heavier or sour crudes, and the benefits of those price differentials have really evaporated in the last couple of months, and that's really hurt the refiners. So we are very negative on the refiners and continue to be as we move into the end of the year.
There's been a lot of talk, as you mentioned, fundamentals. There's been a lot of talk about the global economic picture and how that's going to be sort of translated into the price of oil. Mm-hmm. There are others who are saying that the commodity is really just more of a currency movement these days, that it's more of a paper, less of a product move.
Certainly,
right now.
And I think that part of the move that we've had in the early part of this year is a reflection of not only the equity markets, but also concern that some of the monetary and fiscal policies coming out of the government will be inflationary down
mm-hmm.
the road, and certainly commodities, whether they be oil or gold or any other commodity, are sort of a hedge against that inflation. So that has also contributed to that. But I think certainly there is a great deal of validity in that argument. But currently, fundamentals are just so weak, and demand, we have seen really no demand improvement. Mm-hmm. And the market was hoping earlier, also from an equity market standpoint of view, that we would have an improvement in the consumer, and we did see some glimmers of hope. But some of the data that's come out recently is sort of dashing that. Certainly, the confidence that came out yesterday.
Right. Well, when you say the commodity market's a bit of a hedge with inflation, mm-hmm. there. you would see that as telegraphing the market's view that inflation is here, it's coming?
I think they're concerned that inflation will be coming, and also in the near term, it's certainly, we've had weakness in the dollar since the start of the year,
right.
And basically when, the dollar is weak, that provide, basically investors, that usually juices the price of commodities.
All right. Thanks so much, Ann Kohler. Stick with us. The price of crude oil pulling back fairly substantially in the wake of that greater than expected build in crude oil inventories. But we also have earnings of the energy companies themselves ahead. A lot to talk about oil in the remainder of the year and just how it factors into this global recovery that many are hoping for sometime soon. Are we going to see any kind of price correction in the price of oil? Follow through here. Keep it on Bloomberg. Stick with us. More with Ann Kohler up next. We're back now with Ann Kohler, analyst at Caris Company. Yesterday, we heard from Valero, a refiner. They had their first second quarter loss that they've seen. So what's happening for the refineries themselves? How much of the consumer story is hurting them? How much of it is sort of broader fundamental questions?
It's really a combination of both. I mean, for a lot of these refiners, they have kind of built their systems to handle running heavy and sour crudes. And traditionally, there's been a steep discount in price between those crudes and WTI. For heavy, maybe it's been $15. In the last couple of quarters, that's contracted to, $3, $4. And so that has really hurt their profitability. And that's really a reflection of OPEC cutting their production. When they cut the heavier and more sour barrels because they're less favorable. More people want the sweet barrels. And so that contraction has really crimped. Not only will it crimp Valero's earnings here, but as the rest of the refiners report, and certainly Conoco and Hess reported, that also negatively impacted their income. And that will continue over the balance of the year, I believe. On the other side, you've had basically almost no driving season. Maybe you've seen 100,000, 200,000 barrel a day increase. Normally that number is 500,000 barrels a day. So the demand just isn't there. With high unemployment, about 30% of demand is related to a job.
Right.
So, we've seen that very significantly impacted gasoline demand.
What do you do if you own Valero right now?
At this point, I would look to sell Valero. I have a below average rating on them at a $14 target. I just took my target down this morning. Clearly the second half, not just for Valero, but for all these refiners, is going to be very challenging. Refining margins typically peak in the second quarter. This year, we think they've peaked in the first quarter. And so certainly it's going to be a very difficult environment. At this point, we're pretty much through the summer driving season. We're now facing the heating oil season. And as we saw today, those distillate inventories increased. And we already have distillate inventories at basically record highs. So that means that refiners are going to have to cut runs and hope for there's some sort of improvement in demand because they need to get those inventories down.
All right. Well, thank you so much.
Thank you.
We will continue to follow this oil story into hurricane season and beyond. Thank you so much, Ann.